Hello and welcome to CMC Markets Weekly Market Outlook for the week of September the 8th, 2014. My name is Colin Cieszynski, Chief Market Strategist. The week that's just wrapping up of September the 1st was a really active week for markets. We saw a lot of action in the US dollar, in the euro, in indices, and some of the main reasons for this were around the surprise ECB decision, where they've decided to cut interest rates as well as bring in a new QE program. Then, of course, we had the US employment figures, the ADP and the non-farm payrolls, both of which came in a little bit soft. So that drove a lot of action in the markets last week. This week, the economic calendar is a lot lighter. There are some, overall less news. There's not much in the way of corporate news because we're in between earnings seasons, and there's not much in the way of economic news. I will speak to some of the highlights that we do have a little bit later. Something we are seeing heading into the new week, and the theme we may see play out, is one of consolidation and retrenchment. We have a lot of indices and the US dollar have staged big moves over the last few weeks. A lot of these moves are looking tired, they're looking overextended, and potentially due for a correction. And I'll start with a couple of examples of this. We'll look at the US 30, which shows that heading into the end of the week and into the middle of September, we've had a big rally in the market. We had a summer correction. The rebound and late August and into September has been stalling out short of the 17,150 resistance level. It looks like we're getting a double top forming in the Dow, and RSI here down at the bottom shows that momentum is rolling over. Upward momentum is slowing. It looks like we may be moving into a corrective period for the US 30. Similarly, if we take a peek here at the S&P 500, we've seen the index get up close to the 2000 level, and it's starting to roll over. We have a negative divergence here in the RSI indicator. It's become overbought. It's starting to roll over. We may be on the verge of starting a correction here. The key support level for the S&P continues to be 1990. That was its previous breakout point. If this starts to falter, we could see a correction back to the 50-day moving average here near around 1970, and the first Fibonacci retracement is down here around 1905, which coincides with some previous highs and lows. So U.S. indices are looking a little bit tired and vulnerable heading into the current week. The main event of the week, however, really is on the corporate side, and that is Apple's iPhone 6 and possibly the iWatch launch announcement. Apple has had a huge run in the last few months, and recently it traded up to an all-time high. On a split-adjusted basis, it carried above the $100 level. However, because of the huge advance we've had, expectations are also very high going into the product launch, and we have to wonder if this has already been fully priced in, and if there's room possibly for disappointment in the shares. And the reason for this showed up in the week that just passed, where we saw Apple shares take a big tumble, not on Apple news, but on Samsung news. Samsung launched two of its own new Galaxy Note smartphones this week, and their shares picked up and Apple shares took a tumble. It suggests that because of the rally we've had, some people may be looking to take profits against the news, and in this case it looks as though some people may even be looking to take some profits off the table ahead of the news. Because of this, we could see a lot of choppiness and a lot of action in Apple shares heading right through the product announcement. We're currently seeing some resistance come in around the $100 level. The peak is just short of $104, and the initial support levels for Apple turn up around just below $98, and a Fibonacci level here around $96. As we can see on the RSI, Apple shares have become quite overbought, but with the RSI back at 50, some of that may have started to ease. We still expect to see quite a bit of action in Apple this week. We may not also see in Apple itself, but also in the shares of some of its competitors. If we look at the Blackberry chart here, which tends to trade somewhat opposite to Apple as a competitor, and something to note as we move into Apple's new technology announcements is that in the smartphone sector, it's critical to stay out ahead of the curve technology to remain a leader. There's a number of companies that used to be leaders that have seen their shares tumble dramatically in recent years, having given up the market leadership. One of the best examples of this is Blackberry. More recently, though, we have seen seen the shares start to improve. It had a rally in June and July, a bit of a correction. It started to pick up. It's trading back above $10 US at a Fibonacci level. First resistance for Blackberry appears around the 1150, 1165 area. But the lessons of Blackberry show to Apple that it's under a huge amount of pressure to deliver on expectations, not only on sales, but also on technology. And even if it does come out with something good but can't live up to the expectations that are out there in the market, Apple could be vulnerable to a lot of volatility over the next week or so. Looking ahead now to the economic news, there are a few things that are quite significant. The first of which is that we start to see the focus turn to Asia-Pacific markets, and this is normal in the second week of the month. The first week of the month is usually dominated by U.S. payrolls, purchasing managers, and central bank meetings. The second week is usually dominated by Asia-Pacific markets. This month is no exception. So the highlight we do get is China trade news, which actually comes out on the weekend before we even see the week starts. So when we arrive on Monday, we should already be starting to get Chinese trade information. As well, we get inflation numbers for China during the week, and next weekend we get the Chinese retail sales and industrial production. What's a significant market there, of course, is markets that are sensitive to China include copper, particularly Chinese indices, the China A, as well as the Hang Seng, and the markets of countries that export to China, such as Australia and New Zealand. Looking at the Hang Seng here, it's had a fantastic run over the last 6 months, but it is also starting to look tired. Although the index has continued to advance, there's been lower highs in the RSI. This is a negative divergence that suggests upward momentum is slowing. We could be due for a bit of a correction here in the Hong Kong. It's finding resistance around 25,380. First support may appear around the 25,000 level. This is a big round number, big psychological barrier, so we could see a test of that. If that were to fail, there's a channel support level here in and around 24,650. As I noted, the Australian market could also be active this week, not only on China data, but also on the Australian employment report is due this week. Last week at the RBA meeting, and they continued their neutral stance. Governor Stevens started to back away from a dovish outlook to a more neutral outlook, and we have seen the Australian dollar start to respond to that. It's broken out of a downtrend. It's climbed back above this Fibonacci level here near 93.40, testing 94 with more upside resistance in and around 95. RSI is trying to break out of a downtrend, suggesting an uptick in momentum. Downside if it falters in and around 93, perhaps around 92.40 here. Another currency that we could see some interest in this week is the New Zealand dollar, which is New Zealand is home to the one central bank meeting scheduled for this week. The RBNZ is having a meeting, and I'll just bring the dollar up here. After the last meeting, so to start the year, the RBNZ had 4 quarter-point increases in a row. At its last meeting, the central bank paused on its program, and that sent the dollar, and also complained about the valuation of the New Zealand dollar. Because of that, we've seen over the last couple of months a big tumble in the Kiwi dollar. It's dropped from a high near 88.35, more recently trading back down near 88.70. So it's had a good solid thumping in the marketplace. We are starting to see, though, a positive divergence show up in the RSI. It has been oversold. It's at a point where technically it could start to stabilize and perhaps rebound a little bit here. For current Fibonacci support in and around 82.70, with next support, if it was to continue to carry further lower, near 81.35. If we do get a rebound, first resistance level appears near 84 even, with the next resistance in around 85, 85.20. In addition to the RBNZ decision, where basically they are expected to remain on hold, the inflation in New Zealand has been coming back off. Those pressures have been easing, so we expect that they'll continue to pause likely through the rest of this year. We also do get purchasing managers numbers for the New Zealand as well later in the week. Another aspect of trading for the week is traders starting to look ahead to events that may occur later in the month, beyond next Friday and farther into September. There's a few in particular of note. First of all, the U.S. Fed meeting is being held on Tuesday, Wednesday, September the 16th and 17th. We've seen there had been a huge rally in the U.S. dollar against a number of currencies over the last few weeks. It's actually started to come back off a bit today following the soft employment employment numbers, the Fed has been under a lot of pressure to start to take a more hawkish tone, to start to look at raising interest rates sooner than they'd been planned, with the U.S. economy accelerating. With the soft U.S. employment numbers, this pressure has come off a little bit, but we'll really start to see where we're at with the Fed meeting. There was one hawkish dissenter at the last meeting. This time around, we'll see if there's any more. And one market where we may particularly see action off of that is the gold price. Gold has been in steady retreat for the last 2 months. This is as the U.S. dollar has been rallying. Gold has been going down against the U.S. dollar. This is a function of the speculation that the Fed may start to move to a more hawkish stance. Even with a bit of a rebound on Friday off the soft U.S. employment news, RSI momentum remains negative. This downtrend, falling channel remains intact. People are still looking to see if there's a potentially more hawkish Fed. We're trading in and around 1265. It is possible the May-June lows in and around 1240 could yet be retested. If we do get a bounce, first resistance with this channel resistance line appears in and around the 1280 to 1290 area for gold. Another market we expect to see potentially quite active over the next few weeks is the pound. The reason for this is that the Scottish independence referendum is scheduled for Thursday, September 18th, so less than 10 days from now. We've seen that in recent days, and particularly since through July and August, the pound was under steady distribution. It stabilized for a bit in late August. It's had another downdraft here on Friday. The 5th here, we're starting to see the potential for some bottoming. This is a hammer candle forming here. It's possible we may be seeing a low, but it's a little early to call. We're very oversold on the RSI here, so there is potential for a technical bounce in the pound. The UK has started to uptick on its inflation expectations, which could put some pressure on the Bank of England to start to raise rates in the coming months, but first, really, the main focus is on this referendum. If there's a no vote, you could potentially see a rebound in the pound. Clearly, if there was a yes vote, then it may continue to decline. We've seen we've had these types of referendums take place in Canada in the past. We have seen significant trading action around those dates, so we could see quite a lot of activity in the pound in the coming weeks, depending on how things shake out. If we do get a rebound, initial Fibonacci resistance around 163.75. Then around 165.30. Finally, the one thing that is coming up that we don't have a date for yet is the Alibaba IPO. It is mainly being seen reflected in the price of Yahoo shares. And they're supposed to be starting their roadshow, and basically with the IPO date set for later in the month. I'm just going to bring up the Yahoo chart here to show, unlike a lot of IPOs, which are brand new companies that have never been reflected in the marketplace before, in this case we actually have a proxy for Alibaba, and that's Yahoo. Yahoo owns a significant stake in Alibaba, so Alibaba's valuation does get priced into Yahoo share trading. So what did we see? We've seen a huge rally in Yahoo through 2012, 2013, a correction at the beginning of this year, stabilization through the early summer. We're starting to see another rally for Yahoo here into the IPO now that it's expected to be coming within a few weeks. 40 could present an initial resistance barrier, then around 41.70. It will be interesting to see if we see speculation heading into the IPO, and then what kind of profit taking we may or may not see after it actually occurs. So we're certainly looking for a busy week in the stock markets. Even though there's not a lot of news, there's still a lot of room for speculation in the marketplace. It's also important to remember that September historically is generally a volatile month for markets anyways. In particular, historically it's been one of the worst months of the year for stocks. We do see corrections in September. We may see one this year, and but certainly it does look as though we could see quite a bit of action over the next week. So that wraps up my comments for this week, and I look forward to speaking to you again next week.